I told you that I would show you how to triple your retirement income, and I just showed you a good way to double your retirement income, but now let's step it up a notch and talk about how to triple your retirement income. We're taking this to the next level, okay? When you buy a car, you might put a little bit of a down payment down and leverage the bank's money to help pay for that car, right? The bank will loan you money to pay for a car because the car is used as collateral to secure the loan. When you buy a house, the bank will loan you money to pay for that house. You might put 20% down, the bank puts down 80%, right? That's called leverage because they are using the house as collateral. Now, I hope you're sitting down because the bank will also loan you money to buy life insurance. I know, it sounds crazy, but they're using the life insurance as collateral. Crazy, huh? All right, here's how it works. When you're filling out an application for life insurance, it asks, will this policy be funded using premium financing? In other words, are you borrowing the money to make the premium payments? Right? How crazy is that? You can say, yes, I am. It's a product. This is a product called Kaizen. Now, this is one of many. There's a lot of different premium financing products. Most premium financing plans require 40 to 60 million in a net worth, and you have to put up some hard money as collateral. This product doesn't require any collateral other than your 5 years of payments. Okay? No collateral. Now, you do have to make at least $200,000 a year to qualify for this. Okay? But you put in 5 years of payments and the bank will loan you money and almost match your payments. Depending on your age, they could match dollar for dollar, but it depends on your age. In this example, you're putting in $40,000 years 1 through 5, and the bank is going to put in $28,741 for this example. Years 1 through 5. Then years 6 through 10, the bank puts in the full contribution. You are done. Okay? The bank puts in all the money years 6 through 10. Now, yes, they're loaning you this money, but they're loaning you the money at historically lower than what your policy could earn. So they're using your money and the life insurance as collateral in this example. That is $480,000 in leverage. Just like buying a house and borrowing 80% of the house from the bank, you're now borrowing the money from the bank to pay for your life insurance. Now, I'm just going to give you a minute for that to sink in because that is a crazy concept. Now, if you just put in that same $40,000 a year for 5 years into some traditional 4% rule kind of scenario, your annual distributions, your annual income would be an estimated $37,000. If you used that $40,000 for 5 years into a traditional self-funded policy like I just showed you a minute ago, then your death benefit would be about $427,000, $2 million total for a potential annual policy distribution of about $60,000 a year. Again, $60,000 is about double the retirement income. I showed you how to double your retirement income. Now, by using the bank's money, The first thing that we benefit from is more protection. We're getting more life insurance to protect our family. Now, again, remember, we don't want the maximum life insurance. We want the minimum life insurance, but we do have to buy enough life insurance to make the IRS happy to avoid a MEC. And because we're putting in so much more money, we have to buy more life insurance. But the benefit is that we get more protection. We get more life insurance. And we get more money. We get more money into our account. And our estimated distributions after the loan is paid, after we pay back the bank, after the bank gets their money, the estimated income is $93,000. That is triple the retirement income. That is how you do it. Now, there are some pros and cons. You do have to be a higher net worth family. You have to make at least $200,000 a year for you to qualify for this program. And you have to put in those 5 years of payments because that is used to secure the whole plan. This is also all in some Nevada trust that is safe and secure from lawsuits, creditors, and bankruptcies. Okay? And the other thing is they have stress tested this through the 1980s high interest rate environments. So if we had to pay the maximum amount to the bank on the loans, and through the Great Depression, if we had several years of not making any money, we're still looking at around $60,000 a year of income in some of the worst environments, the highest interest rate environments where we have to pay the bank maximum loan amounts, and Great Depression environments. This has been stress tested. That's why the banks are willing to loan the money. They believe that it is a safe investment. It's safe. They're using all of this as collateral and they feel like it's a very safe investment. Now, this is a lot of numbers, but I want to show you real quick how this works. Okay? What happens is that you put in your money, the bank puts in their money, and then after 10 years, no more money is going in. So you put in money for 5 years, and by the way, you're probably not going to make sense of this until we sit down and look at this one-on-one, but you can also run your own numbers on our website. I'm going to show you how to run your own numbers on our website in just a second. But I just want to explain the quick concept. You put in money for 5 years, the bank puts in money for 10 years, and then nothing happens for 5 years except for all the money grows. You're making a positive gain on the money that you borrowed from the bank. You're also making money on your money. And then in year 15, you take out a loan, just like taking out a loan to pay for college or just like taking out a loan for retirement. You take out a loan to pay off the bank. And at that point, the lien holder is gone, okay? And it's yours. Up until year 15, you don't have access to any of that money. This is designed more for retirement. You can't use this to pay for college unless your kids are really, really young, okay? Because you can't access the money in the first 15 years. That's why most of our clients have two policies. They have a regular policy and then they have a premium finance policy for retirement. So there are limitations to this particular plan. This particular plan is more of a long-term plan for retirement. Also, if you're in your 60s, you might not like this for yourself, but you might love this to buy a policy on your kids. If you are in your 60s or 70s and you want to start transferring wealth to the next generation, if you want to leave money behind, you can gift $17,000 each. As a husband and a wife, you can gift $17,000 each to your kids. You could put that money into one of these plans. The bank will match your contributions on a 20-year-old, and your kids can't get to the money for 15 years. And then after 15 years, you have set your kids up for an awesome retirement. So this can be used for a number of ways. If you're in your 20s or your 30s and you're high income, in your 20s and 30s, this could be amazing for your retirement. If you're in your 40s and 50s, it works great. If you're older, you might want to look at it for your kids as a way of transferring wealth, because there's that 15 years that you have to wait before you can take a loan. Now again, you're taking a loan at 5%. Your money, including the bank's money, is all still compounding at 6%. That is what we call leverage. That is what we call positive arbitrage. That is taking it up a notch and tripling your retirement income. Now, again, you want to go to, let's see here, let me go back over here. You're going to want to go to our website and run your own numbers. This particular company has an awesome software that you can actually run your own numbers. So you're going to go to retirementrestoration.com. Now maybe you're watching this video on retirementrestoration.com because we have this video on this page. So somewhere on this page, there should be a link that you can click on to run your own numbers. If you're watching this video on YouTube or somewhere else or on social media, then go to retirementrestoration.com and run your own numbers. And you can see exactly how this would apply to you.